Alrighty, starting to get some folks pulling through here right now. We're being joined by the amazing team at JPM Morgan with Alan and Molly. We're going to jump into cap table management. We're going to let some attendees come through. I'll share our LinkedIn's and some additional information, but we'll just give it a minute or two and we'll pop right in. While you're coming in, if you wanted to drop your LinkedIn, tell us where you're dialing in from, location, maybe company name, what you're working on, would be awesome to see in the chat. All right. Starting to get some folks in, so figure we could kick off here. You were excited for everyone to join today. This session is going to be recorded, so we will be able to distribute it afterwards on our blog as well as on LinkedIn, and you'll get it via email as well as a follow-up. This is our fourth incredible community chat brought to you by Bionic Labs in partnership here with JPM Morgan. For us, as we look at the economic environment, it's complicated, it's difficult, complex world to navigate. So we wanted to bring together chats with experts in the space to help simplify the journey for our founders as well as community, from everything from how to build a deck to how to manage your cap table, to how to find investors, build your financial model, and then accelerate into actually onboarding customers from a growth perspective. Because at Bionic, we're a collaborative that brings together the early stage startup community for founders, operators, and partners together. We're a collective focused on building more durable companies with sustainable and scalable growth to reach product market fit faster. Startups are hard, so we're here to help you break down those barriers and get you from pre-seed to A in a more timely manner. A little bit about me. I've been in the startup ecosystem for about 20 years. My name is Justin Cohen, if I didn't say that earlier. I've been building marketing and product functions for some of the fastest growing companies based here in Chicago, helped reach over $1 billion in total exit value. I've also been an active angel investor with over 16 companies in the portfolio, 2 hitting unicorn, 1 having an IPO. And I'm continuing to be engaged there, as well as a mentor at Techstars, and now building Bionic Labs, which is focused on being a growth studio to help early stage companies scale faster and more repeatably. So when we're going to be jumping into this session, I'm going to give you a little bit of an intro about Alan. One thing I did want to call out about this session is that with JPM and global shares, you're able to have up to 100 shareholders on the platform. So when you're taking a look at this solution, which is awesome, this is not a sales pitch, but this is definitely intended to be more of a conversation about how to manage your cap table more simplified, but it's always an alternative to think about. And we'll follow up with that information as well. So without further ado, I wanted to give a quick background and bio for Alan, and then I'll let him take it over from here. When we get into the chat, feel free to drop your questions into the Q&A, and we'll definitely get to those. We want this to be an iterative and collaborative discussion, so don't hesitate to reach out in the Q&A section. So Alan is the vice president at JPM Morgan. He helps lead business development, strategy, and partnerships for the cap table team. Before joining JPM Morgan, Alan was the global shares acquired by JPM Morgan in August 2022. He has 5 years of experience working directly with companies and their cap tables, as well as previous consulting and investor experience in the venture capital space. So I'll let Alan take it from here, and I'm excited to learn as well. Thanks, Alan.
Thank you very much, Justin. Much appreciated. And thanks to everyone for taking the time to go through a chat with us today and take a look at some of the best practices that we have experienced around cap table management, and generally, I suppose, the startup experience. Like Justin mentioned, I think a big part of sessions like this is kind of imparting as much information as we can, and we're very focused, I suppose, on getting you through the rounds. Like Justin said, getting you from seed to Series A is a big part of Bionic's mission, and same for us, getting you from pre-seed through seed through Series A and beyond, and working with you as you grow your company. So hopefully looking to kind of demystify some of the myths and the terminology around cap table management today. And I think like our tagline, I suppose, in Global Shares JP Morgan is cap table management simplified, and same for the session today. I think that's really what we want to try and do, is just simplify a lot of the terminology and the process and practice around cap table management. So really what I want you to get out of today is to understand some of the terms, be aware of them, start to understand what they mean, and ultimately, if we can start to see around some of the corners for you and point out some of the potential pitfalls, and hopefully they're pitfalls that you can avoid by attending today. So excited to see some questions roll in. Definitely keep it interactive. I'll screen share shortly. The plan for today is to go through, number one, I suppose, the problem that we're trying to solve. And I suppose what we see for early stage companies quite a lot is them managing their ownership and the value of their company on spreadsheets. So that's the first thing I'm going to show when I screen share, just to show you what that looks like. I think the overarching mission around cap table management is digitizing. I suppose that's the big thing that we'll say to early stage companies like yourselves, is that's a huge part of the best practice, is to digitize, get your cap table management, or your cap table and ownership and equity data onto a platform. In this day and age, there's enough platforms out there, whether you choose us or choose another platform to manage it on. There's too much risk associated with managing this really inherently valuable piece of data on a spreadsheet. So I think that's the first piece we'll touch on. I'll touch on two other main things outside of digitizing your ownership and knowing your ownership around best practices. The second piece is being prepared for fundraising and how that touches on the cap table and how that will ultimately change the ownership in your company. And then the last piece is preparing for growth. So preparing for growth, not just of the company, hopefully, it is as you go through and scale through the rounds, but also your team, and how your team touches the cap table, where stock options come into play, and some of the best practices around that. So I'm going to go ahead and do my first screen share. And really what I want you to get out of the first screen share is just understanding the main problem that we're really trying to solve as a team and as an organization when it comes to cap table management. So this is typically what we see when we onboard a company. And it's usually the first piece of information that a company will use, and naturally so. I mean, this is really the first thing that you're going to have when you split your founder's shares, maybe 50-50 or something along those lines. You're starting to bring in all of your share class detail, how many shares are issued for the company, what does the cap table look like? So this is usually the first thing that we'll see. But ultimately, there's so much risk associated with keeping all of this cap table and equity data on a spreadsheet. We all know they can be corrupted. There can be multiple versions associated with both yourselves as founders, maybe early investors, accountants, or who are other advisors that you're working with might have different versions. So really what we want to be able to do first and foremost is digitize. So I'm going to go ahead and re-screen share and give you a quick look at our platform. I think, like Justin said, definitely not a selling exercise, but I think it's an educational experience to go through seeing a platform and starting to join some dots between a lot of these terms and practices and processes as they relate to cap table management. So first best practice I want to go through is really knowing who owns your company. It sounds like a simple thing, but something that can be quite straightforward today, but becomes hugely complex when you do go ahead and raise that first round, even if it's an angel round. More so when it becomes your first institutional round, but even at an angel round, you're going to have different terms for individuals. You obviously have different information and details for those individual angel investors. They're likely going to be fundraising or investing on some type of convertible loan note, whether it's a pre or post money safe or some variation of a convertible loan note. We'll go into that when we touch on the fundraising side, but naturally there's going to be complexity in the cap table. So I think that's the first thing that we want to impart to founders, is knowing who owns your company at any given point in time is huge. Again, it touches on the fundraising process. You're having investor conversations. One of the first questions, and what as part of their portfolio construction, is understanding what the cap table looks like right now. Does it make sense for them to come in and invest? They might have every reason in the world to invest in your company. They might love you as a founder. They might love the idea. They see a massive market opportunity. But if the cap table isn't in a good shape for them to come in and sit on it and buy equity in your company, then it's going to have a massive negative effect on your fundraising process. So knowing who owns your company first and foremost, huge in terms of best practice. obviously, like we said, I think digitizing is a huge part. So like whether you use our platform or other platforms out there, I think that's the first thing you should do in trying to preempt a lot of these problems that will come up. So we do it in a few different ways. You'll see platform wise here, we'll show the cap table by stakeholder and by share class. That's really just allowing you to understand the different share classes. What you'll typically come across is common and preferred stock. Usually, and again, this is kind of the start of demystifying some of these terminologies and just becoming aware of the terminologies. Usually common stock is going to be founder shares or employee stock. So typically if we have stock options, they're going to be common shares versus the preference share or the preference stack you will hear it being referred to. They're usually investor shares. Sometimes there is scenarios where you might have founder shares having more preference type terms built into the back. It just depends on what the setup is from the outset and how it progresses through the rounds. This just really allows you to be informed and empowered with all of that information, and just knowing that there's going to be different terminology and different terms built into the back of each of the preference shares and the type of class that it is. So really what we want to be able to do platform wise is just provide you with an easy solution to be able to navigate and digest all of this information. The next piece we want to go through in terms of best practices, being prepared for fundraising. So that obviously comes with a whole bunch of different pieces of information that are probably going to sit in what you'll hear referred to as a data room. So in terms of data room, you'll probably have everything from, if you have early customers and early traction, you might have some LOIs or pilots or customer contracts. You might have your financial model, your operating model, some financial forecasts, also your cap table. That's another key piece of the data. And I think that's how I try to tie in cap table in terms of the whole fundraising process. It's one piece of the pie, but it's a hugely important piece of the pie in terms of the data that you're going to need to have in place when you're presenting to investors and what investors will ultimately expect to be in place. So what we do in terms of solution, we try to provide a tool that's super simple for you to navigate in terms of modeling out what the next round would look like. So this becomes very useful when you've maybe raised a small angel round, you have some convertible loan notes in place, and you want to go and raise your first big institutional round. And I think in terms of cap table best practice, again, we'll keep looping back to that. Being prepared is one of the, I mean, it sounds so vague and obvious, but just understanding what your cap table looks like right now, being prepared for a lot of the questions that investors are ultimately going to ask you during the fundraising process is massively, massively important. So part of the modeling is knowing how much you want to raise. So for this example, I've said, okay, what happens if I raise 3 million? Knowing what the potential pre-money is, whether it's an estimation or just having some idea of what your pre-money valuation will be. We'll touch on it a little bit later, but this was one piece that will become very important for you to be aware of and start to plan for. And again, back to being prepared, is a post-money option pool. This is where you'll have an allocated pool of shares put aside for your employees typically, but stock options that you're going to issue out post-investment. It can be done on a pre-money basis. So again, in terms of terminology, you might come across pre-money option pool. More often than not, what we see is a post-money option pool. Some different knock-on effects. Probably the main knock-on effect of having a post-money option pool is that the existing investors will be diluted versus if you have a pre-money option pool, it will work in reverse. Again, different terms can be built in as part of a round, but that's typically how you're going to see it work. And again, knock-on effect is, like I mentioned, dilution. So as we run these rounds for you as founders, I think that should be really top of mind as number one, understanding dilution and what it is and how it potentially will affect you in the future. But a tool like this is super, super useful to be able to empower yourself with that information. Because I think number one, if you're choosing to go on the venture journey and raise venture dollars, dilution is going to be a natural part of the process. But I suppose that's kind of a decision you make as a founder, where you're kind of thinking more along the lines of, I want to own maybe a smaller part of a very, very large company versus owning 100% of a smaller company. So it's just a different journey ultimately when you do decide to raise venture dollars. But understanding what that looks like, again, back to the investor conversations and ultimately all of the signals that you're sending out as part of that process, hugely important to understand what that will look like post-investment. So what we allow you to do, as well as converting all these convertible loan notes, is run that scenario. So again, makes it super simple to be able to see what this looks like after you've raised. This gives you some high-level information. One of the key terms to be aware of is post-money valuation. So pretty simple calculation, just your pre-money. So whatever you decided was your pre-money valuation. in addition to the total round. So that will give us 18 million. You have your new share price. Important to understand how much equity you're giving away. So this again will come back to being aware of maybe what the particular investor that might be leading your round or involved in your round, what their portfolio construction looks like, what their target percentage ownership. And again, we can derive that from knowing how much equity we're giving away as part of a round. We will visualize here in terms of platform to be able to understand what that looks like. But again, back to the kind of the more important piece of when you're modeling out these scenarios is your own dilution. I think understanding that your percentage ownership is naturally going to decrease when you go ahead and raise outside capital. So what we allow you to do here is to be able to double click, see your percentage dilution. But again, this will allow you to make informed decisions as you go ahead and raise, to understand what your ownership will be. And this comes back to kind of motivation, you knowing you have enough skin in the game to continue to build and grow. We'll touch on this slightly as well as we go into the last kind of cap table best practice around growing your team and stock options. So keep this top of mind as we go in there. One of the other pieces that we always like to highlight is around convertible loan notes. So you'll probably have come across these in some shape or form. Maybe some folks on the call have used convertible loan notes to raise capital to date, or potentially will use in the future. It ultimately allows you to, number one, not set a price of the company. It allows an efficient and effective way for early investors to be able to get access to the company, and then ultimately allow their investments to turn into equity at a particular financing round in the future. But one of the key things I suppose we see, and it's a potential pitfall for early stage companies, is because the loan notes are so efficient, they make so much sense to use to raise capital quickly, not preparing for the future to be able to say, okay, all of this is going to convert into equity and take up a decent chunk of my company in the future. So what we want to be able to do is empower you with that figure, even just this figure alone, to say, okay, if my 4 convertible loan notes convert, they're going to take up potentially 17% of my company in the future. So just understanding and being aware that this potentially will happen going forward. The last piece I want to touch on is around preparing for growth of your company, and how does that relate? You might be thinking, how does that relate back to cap table management? If you think of cap table management, it starts off as who owns your company. Like we mentioned at the very top of the call, it's probably you and your co-founder maybe splitting the company 50-50. You have some early angels, or you might do a friends and family round. You maybe have one employee that's been helping you from the start, and you issue stock options. That particular point is the point that really scales. You go ahead and raise a Series A. It's a big institutional round. As part of that round, we go back to the term that we mentioned earlier around option pool. 10% is a typical option pool that you're going to probably hear in the market. Excuse me. For investors who is typically going to be the lead investor that's going to recommend a 10% option pool be put in place post investment. And this is really to utilize your biggest asset, which is your stock options. Naturally, as a startup, you're probably not going to be able to pay market rate in terms of cash compensation. So your stock options really are your biggest asset at that stage. They have the potential to create significant wealth and access ultimately to the potential upside of the value of the company. So in terms of preparing for growth, I think this is a huge piece. Again, platform-wise, this is what we try to empower you with, the tools to be able to make easy. So the administrative kind of burden or headache that's going to come with managing everything to do with a stock option plan. So you'll hear terms like vesting schedules. You'll hear terms like termination rules, again, option pools you'll hear. These are all things that you really need to be prepared for and aware of as you start to go on the journey and these things come into play. Again, we'll always go back to just being prepared, trying to see around the corners, making sure you understand the terminology and are aware. So I think takeaways are, you'll probably hear something like 10%, 15% option pool post money. Vesting schedules from an employee perspective, what we'll typically see is a 1-year cliff with a 4-year vest. So that means there's a 1-year period where there's no vesting taking place of stock options. Once an employee stays for 1 year, they will then start on a 4-year vesting schedule. And that can be done on a monthly, quarterly, biannually, or an annual basis, depending on what the setup is. These are typically terms that are set by yourself in conjunction with your legal counsel. So in terms of us as a platform, that's not something we do, but we do help in terms of uploading all the information into the platform and make it super simple. Justin mentioned earlier in terms of we offer the platform for free, but we also offer the service to be able to help you to upload all of the data and do the account creation. So we will effectively help you to build your cap table and your stock options plan on platform. But I think back to the kind of practice around preparing for growth, it's a huge thing to start to think about as you think about your cap table management and your equity management, is the growth of your team and the growth of your company. So thinking about the hiring process, thinking about the top talent that you want to retain and motivate once you have hired them, the stock options are going to be a massive part of that. And I think the more venture grows and becomes more widely known around the world, the more we're going to see of this in terms of stock options being issued to employees, founders being more generous in terms of offering more ownership in the company that those employees are effectively building every day. And what we want to try and create, and the kind of the education I suppose we want to create around this, is the flywheel effect. So the more of those employees that have access to the value of the company, they have stock options, they potentially have some liquidity at some stage. All of that hopefully will get recycled back into the ecosystem. So maybe they'll start their own companies, they become angel investors with the liquidity that they've gotten from the stock options, and it all is a very healthy part of the ecosystem. So I think in terms of growth, massively important to be aware and be prepared for that, for your team to grow and scale, but also for the ecosystem at large, massively important thing that it's kind of well known about, and employees understand the potential upside of stock options and how they potentially will work going forward. They are the three main best practices. Hopefully there's been some myths demystified and some of the financial jargon and language simplified around cap table management. Not too sure how many questions there are, Justin, in the chat box, but happy to field some.
Not a ton in here yet, but people feel free to jump in. I do have questions on my side. I think it helped clear up some items too. I think one thing you mentioned, which is super interesting, and I've heard this a bunch from other investors too, is when cap tables are too messy, or when cap tables there is preclusion from investing because of how the cap tables have been structured. What have you seen as some of the primary reasons why an investor may walk away because of the cap table issue?
Yeah, for sure. And I think, like I mentioned earlier, like an investor can come in and look at your company and like love the products, love the traction, love you as a founding team, see the market potential and the size of the market opportunity, potentially see an exit opportunity. But they might look at the cap table and say, you already have one shareholder that's external that owns 50-60% of the company. And if you think of when we mentioned dilution, as much as dilution comes into play for yourselves as founders, for existing stakeholders, it also comes into play for investors. Now, there's different, I suppose, there's different terms that you will maybe come across around anti-dilution and pro rata. That more allows investors to have the right to follow on if they do invest, but ultimately they're going to be diluted as well. So if you think about it, and I think that's a hugely important way to enter investor conversations, is understanding how they think, understanding that they're also, I suppose, they have LPs, they have reporting to do as well, but as part of their fundraising, them raising the money for their funds, they have a specific investment thesis, they have specific ownership targets. So if they look at a cap table and say, okay, there's room for 10% only for us right now with the size check that we can write, is there enough room for us to be diluted through, maybe we do a follow-on round, but for your company to reach the scale that we needed to reach for us to exit and return money to our LPs, is there enough room for us to be diluted through the couple of rounds or three or four rounds that potentially will take place subsequently? So I think that's really the way to think about it, is that investors, as they construct their own portfolios, they have their own ownership targets. And if they see a cap table that doesn't align with that, then it can be a huge red flag for them, or not even a red flag, it just mightn't allow them to fit into their investment thesis and how they construct their portfolio.
Yeah, great answer. We had a question from Vlad. Can I send save or notes via the platform?
Yeah, for sure. So in terms of how we deal with that, is we will create the safe note on the platform first. So we'll upload all the safe note agreements, we'll upload all the safe note details. So whether it's conversions, conversion rate, discounts, caps, what the convertible will convert into, we'll upload all of that, and we'll actually do that for you as well day one. We'll associate that with a stakeholder. One of the pieces that we're working on building into our platform is actually issuing the safe note on platform so that the stakeholder can accept. So that is one thing that we do offline. So it's potentially we use a DocuSign or some type of external signatory piece. Something we're working on building into our platform over the next while, but that's the one piece that we'll do offline. The investor will then have access through our stakeholder management tab, where we'll add them as a stakeholder. We'll issue them an invite to come and create their own portal and create their own account. And then all that convertible instrument, whether it's a SAFE or a CLN or any type of variation, will sit into their own specific portal. And all of that information is bespoke to that investor.
Awesome. And when you were showing the output of the round and that exercise, it showed a dollar per share. It was around $2.30-ish cents, I think I remember.
Yep.
Are you, for those that don't know, from like a 409A perspective, getting outside opinions on your share price, is that something that with JPM's background you're providing as part of the service, or is that secondary or something else that could be provided?
Yeah, so very tangential. It's a service we actually don't do in-house. It's a service we work with external partners to be able to conduct the 409A valuations or any type of valuation. So I suppose for us, we intentionally want to separate those two things, where we are the cap table and the share plan experts. We will do the administration around the share plan, but we want to make sure that that exercise is done separately with experts externally. So in terms of prospects and clients that are interested in getting access to discounted pricing that we have with those partners externally, we're more than happy to give access, but that's not something we do on platform. We intentionally don't. We want to separate those two exercises. We'll upload all of the data to the platform. So Justin, like you mentioned, you'll have seen it in the round modeling, but we include it in our financing history as well as the valuations tab within the platform. So we're uploading and tracking all of that historical transaction data.
That's awesome. And then you mentioned, and then I'll get to a question here in the chat too. Building on the 409A, we mentioned, liquidity. Do you use a third-party service for secondary rounds for investors and shareholders if they're looking to exit on that side? Is that something you facilitate? I'm always interested to hear kind of how that works as well.
Yeah, so I mean, number one, not something we facilitate, it's something we will definitely reflect on the platform. So obviously, I think that's something that we're seeing a bit more widely used in the market, especially in current market conditions. You're seeing secondaries pop up in the headlines a little bit more, and I think it's a good thing in terms of being able to provide liquidity for maybe early investors, early angels, early employees. It's not something that we transact or that we offer the service on platform, but certainly something that we can help with reflecting if that event has taken place in your company.
Although there's always equal footing in terms of different options and solutions that are in this space, and everyone plays nice, there's a question of how is your platform better than Carta, or where would you see the differences, I would say?
Yeah, I mean, look, it's a small industry. I think there's only a certain amount of players in the share plan and cap table space, and Carta in particular, I think have done an amazing job. Like, they've effectively created the cap table management category. So amazing platform, great product, and I think they've really served the venture ecosystem exceptionally well. We're definitely looking to come in and provide an alternative and provide a good solution. What we're trying to be really competitive is around trying to make our platform as founder friendly as possible, make it as simple and easy to navigate. So hopefully you'd have seen that from the screen share, where you can see how kind of easily digestible the information is, how easy it is to access and navigate, but as well as providing as much resource outside of cap table management as we possibly can. So I suppose that's where we see ourselves as very strong, as we're not just a cap table management platform now that we're part of the JP Morgan ecosystem. Whether it's Molly's team that can help on the banking side, whether it's our private bank that can help when founders eventually have some liquidity through hopefully an exit at some stage, that we can help them navigate that scenario. So I think in terms of network and access and resource, that's a massive thing that we can offer. I think our pricing is pretty competitive. Look, at the end of the day, you're all early stage founders, early stage companies looking to be as lean and cut down on cost and burn as much as possible. So if we can provide a resource that's free of charge and hopefully get you through multiple rounds. So our thinking is that when we offer the platform for free up to 100 stakeholders, we can hopefully get you through to Series A, Series B, depending on how many stakeholders you have at that stage. But ideally, we can get you through multiple rounds without having to pay for cap table management. So I think that's obviously very competitive as well. It's not something we want to lead on. I think there's value in the platform, value in the network, value in the expertise of our team, and where we can help you get connected to. And look, ultimately, we want to be able to grow with you, and we're in a great position that you kind of can't outgrow us. Like, we can work with you from incorporation all the way through to being the biggest company in the world. So yeah, everyone has their strengths and weaknesses. I think we're competitive in certain areas, but look, ultimately, it's the more companies in the space, the better, and the more services and the more products that are available for founders to be able to grow and succeed, the better.
Exactly. I think that's always a good part is that when there's more services, everything becomes, better across the board versus just a monopoly. But one thing I did want to add, I think you mentioned, with Molly here on the JPM team too, it's hard to get banking as a startup founder. There's a lot of gaps in that space, especially with Silicon Valley Bank, up and down and changes. Sometimes you don't get great banking services and providers. That's something that Molly and I we're connecting on at a venture event, and JPM is definitely leading into. So being able to have access on both ends is very important to get up and going, and then get your credit card, get your debit card, and build and so forth as a service. So there's a lot of tangible opportunities there. A question that came in as well is, can you share more details on how a cap table can get upside down? Lack of founder vesting, too many stacked safes, etc. Any thoughts there?
Yeah, for sure. So another version of a demonstration that we used to do before was purely focusing on pitfalls. I've kind of changed the presentation a little bit recently, just to be, I suppose, looking at more of the positives and looking at more of the potential upside. But yeah, absolutely, there's going to be pitfalls that will come into place, and definitely, I suppose, the number of the points that you just touched on there around cap table management, it comes back to, I suppose, the early days around founder dynamics and how founders split their equity from the early days, and just putting best practices in from early as possible. So sometimes it can be easy to gloss over some of those details at the early days when you're just focused on building, or focused on getting an MVP in place. You're focusing on, so strategizing around what the problem is you're trying to solve. But when it comes to actually the technicality around who owns the company, that's hugely important to start. So things like having founders agreements in place, knowing what the founders split in terms of percentages, making sure you're documenting everything very clearly from the start, I think is a huge pitfall to avoid. I think, like we said, it can be something that you can kind of have your verbal agreement with your co-founder or co-founders, but having that documented, I think, is one key piece to do as early as possible. Equally, for giving away early shares to advisors and potentially, again, not documenting it. So we see that quite a lot, where you might have early teams, you might have early advisors that are advising them, and there might be verbal agreements to say, okay, we'll give you X amount of percentage, and there could be a high percentage. It could be something that might seem small early days, but ultimately, as your company grows, 1 or 2% of a very large company is quite a chunk over time, versus it might seem like a very small thing at the start. So just, I think the main thing is documenting, making sure you have everything documented, even though it might seem maybe agreed verbally at the time, but making sure that that's documented, and then just thinking and kind of seeing around the corner in terms of who you're giving equity to at the start. So whether it's advisors, early employees, maybe early investors, thinking about how much equity you're actually giving away and what that potentially can look like in the future.
Great. Kind of building on some additional items on the second, or the setup. Obviously, one key component typically when you're setting up your cap table and distributing equity at the very beginning is your 83B election, ensuring you get that in quickly, so you lock in your price, so you have your upside. Typically 83Bs, your valuation of your shares, what are like 0.00000001 is what typically people go with. Maybe I'm missing a zero or two. But founders then purchase their stock at a very low level, and then there's tremendous upside for you on the K1 capital gains side. And if there's anything I missed there, Alan, please clear that up. But do you facilitate that process as well, submitting the 83B election forms for founders and teams?
So definitely highlighting the importance. I think, like, you've kind of touched on all the main points there, but definitely an important piece to be able to be concentrating on and be aware of. That's not something similar to the valuations that we do on platforms. So that's typically something that needs to be done through your legal counsel in terms of submissions, or else you submit it yourself. So that's something we're somewhat hands off with. We do have the data that's going to be relevant to be able to submit those K1s and 83B elections. So we will have that on platform once everything is kept up to date and live. Again, in terms of updates, that's something we're definitely looking to make a bit easier on the platform. We have reconciliation reports, and we can export pretty much every piece of data off the platform today. We're working on building in some of the templates to make the 83B elections, as well as some other US specific reports, easier. So yeah, definitely something that we'll have the data on, but not something that we will do hands-on submissions or be very closely involved. But we would always make sure you're working with your legal counsel to be able to make sure that's done correctly and accurately.
Yeah, make sure you do it, founders. you'll kick yourself in your second round if you didn't do it. So two other questions I had. One, when we talked about equity to set aside, I think traditionally you see with YC and other services, they recommend 8 to 10 million shares being pulled into the total pool, and then from there issuing like 4 million to your initial team, and then having ability to increase that size. What have you traditionally seen that's worked well? Making sure you set aside enough equity so you're not getting into too much of a dilution phase, or just not having enough equity to deliver, to future team members, investors, etc. How do you look at that?
Yeah, for sure. And it probably comes back to incorporation. Like I think a pitfall that we come across quite a lot is having to do a stock split very early on. So I think, and it probably relates back to the point that we made earlier about deciding to go on the venture journey. I suppose going on the journey is maybe like a bootstrapped or maybe more of a service-based business or whatever type of business it is. That's a decision you probably make when you incorporate. Now, obviously, there's opportunities to change how the company is structured and incorporated, but the number of shares that you issue day one, which we typically will see as maybe being 10 million, for example, because it gives you kind of it's a simple, straightforward figure. It gives you a bit of leeway in terms of the shares that you're issuing out. That's probably the first piece to say, okay, we need to issue enough shares in the company that it makes sense for us to fundraise, that it's easy to split, gives us an opportunity to put an option pool in place. So again, I think that's the first piece, making sure you authorize enough shares and issue enough shares at the start so that you don't have to do a stock split. The reverse of that is issuing maybe 100 shares when you incorporate the company, splitting that 50-50 between the two co-founders, realizing you're going to fundraise and you need an option pool in place and having to do a stock split. So just creates more complexity. So I'd say that's the first piece. Second piece is the actual putting aside of shares for employees or for an option pool. The typical that we'll see is 10-15%. I mean, I think the data is kind of showing Index Ventures have a really good resource with their stock option plan report and playbook, and they kind of outline some of the data around how stock option pools are increasing year on year. And I think that's a really healthy thing for more employees, like we said, to get access to the ownership of the company. But we're seeing that tick up close to 20% in some cases. But 10%, I suppose, is probably the most common one that we'd see. That's generally recommended by your lead investor. It could be something that you decide as a founder in terms of how generous you want to be, or what kind of culture, I suppose, you create ultimately in the company. But again, back to having, say, your 10 million, that allows you to say, okay, we need 1 million of that 10 million to be set aside as a 10% option pool, which will be kind of in line with market. But again, it's these decisions ultimately are down to how you want to set up your company, the culture you want to set, how generous you want to be with the equity. And I think that's something we're obviously big advocates for, is employee ownership. We were an employee-owned company ourselves when JP Morgan acquired us. So I suppose we've seen it firsthand, and like to practice what we preach. I suppose at the end of the day, that we've seen it firsthand how motivating it can be to employees, how bought in you are, how it can make sense in terms of retention and driving value in the company, and everyone being on the same page and aligned. So yeah, I would say the two things are, day one, when you incorporate, kind of be seeing ahead and kind of planning for the future around the total shares that you're going to issue, and then think about kind of what makes sense for your own company culture when you're putting an option pool in place.
Yeah. You mentioned a tool or service. What was the name of that was giving data for issuances and share numbers?
What did I just mention?
And we can get that later too from you.
Yeah, I'm gone blank on what I just mentioned.
We'll get that later.
It'll come back to me in a second, I'm sure.
Yeah. Okay. No worries at all. I think, yeah, like Alan said, make sure to talk to your legal team, make sure to do your research. Everything that I think is coming up is measured twice, cut once. And, if you do it well at the beginning, it's going to be much simpler. It does take a little more work, but you really have to set up your structure right. There are services, it's called Clerky, CLERKY. It's Y Combinator's, legal setup startup service. If you wanted to go very lightweight, they do all the incorporation documents, share agreements. You then can take it to your legal team and then have them update. It's something I've used in the past. There's probably better services or other services that continue to come out, but just make sure you have your legal team reviewing, make sure you have everything set up, make sure you have optionality for yourself. The other last question I have, or statement and conversation you can have, obviously, when you look at RSUs versus RSAs versus options for employees, there's massive differences. As an employee, I'd much rather have RSU shares because I don't have to ever buy them. And but obviously, as a company, it's expensive. Options are cheaper for the company, but eventually could cost employees. When we're looking at a world where you mentioned where we want to be more employee friendly, we want to make sure our employees are and our team is really bought into the organization. And I echo, Alan, what you said, like don't be stingy with your equity. Now, don't be just handing it out without reason behind it. Make sure that your early team members and team members that come in have upside. You're asking them to work hard, grind, and build a vision with and for you. And you really want to ensure that everyone's equitized the right way from a package perspective. So be very mindful with how you're distributing equity, how you incentivize your team. Use it as the opportunity. But when it comes down to how you're seeing equity being distributed, between the various types, what are you seeing and what do you recommend?
And I've just remembered that it is very relevant to the conversation. The resource I mentioned is Index Ventures Option Plan. So publicly available piece of info. If you just do a simple Google Index Ventures Option Plan, you'll see it. They have great information there around the data around what the stock option pools look like, some of the trends around employee compensation. I think to your point, Justin, there's a lot of that information in there. They have really good data around split. They actually have they have boards and charts to kind of split how you would distribute equity to employees, and they'll split it out between technical and non-technical roles, the seniority. Now, there's infinity ways to be able to decide how much equity you want to issue out. And I think it's something, honestly, we're slow to give. I suppose we can't give recommendations really on how much. I think that ultimately comes down to yourselves as a founder. That's a great resource, I think, to point you in the direction of a good resource with Index Ventures Option Plan. It varies ultimately, but I think it comes back to just being prepared for what will happen in the future. Like you said, Justin, you don't want to be too stingy with how much equity you're giving out, but equally you don't want to give out so much that it doesn't make sense for an investor to invest. The cap table is messy and doesn't make sense for others to come in and contribute. But it's ultimately, like everything in life, it's a balancing act to make sure that your employees are motivated. They see that they want you to be sharing in the upside that will potentially be there at some stage, and that's tangible. Back to the options RSUs for sure. I think, look, options probably make more sense for early stage companies. At the end of the day, there's huge risk around joining startups, but equally that should be balanced with the potential upside that an employee will have. RSUs, RSAs, of course, the big difference between RSUs, RSAs, and options is that you don't have to pay for them at any stage. There'll be different vesting schedules. There'll be different terms built into them. But I think ultimately it comes back to communication. I think that we do share plan administration on our other products and global shares for some of the biggest companies in the world. And that's what it comes back to, the communication around the share plan or the stock option plan and the communication around the plans. So there's the technicalities. I think the Index Ventures Option Plan is a great resource to be able to see some of the examples of the percentages that you might give out, but ultimately it comes back to the communication of what the plans are for the company, and how bought in employees can be through using stock options or some type of RSA or RSU.
Awesome. I think that's most of the questions here. Anything, Alan or Molly, you wanted to add on where to find you? Information, we'll obviously send a follow-up to everyone that is registered and on the chat. But anything else you wanted to share? And then I'll give one last announcement and we'll close up for the day.
Appreciate everyone joining, and hopefully our contact info will be in that follow-up. Through Justin, we're a resource to everyone on the call, whether we know you directly or not. And thank you for joining.
Yeah, absolutely. Just echo what Molly is saying. We just want to be a resource, and hopefully we can help out. And hopefully today was useful in kind of demystifying some of the terminology and best practices around cap table management. So, like we said, being a resource to Justin and his team, just reach out to us. You'll have our contact details post call. And yeah, look forward to hopefully connecting at some stage in the future.
Yeah, definitely. Cap tables are challenging and super complicated to manage. So it's great to have solutions available in the space. Obviously, having JPM behind is obviously hugely valuable too. From the last piece on announcement side on our end, May 23rd at 12 p.m., you could join Bionic and Nate Androsky of Patent 355 as we talk about building products that stick, integrating behavioral science and product design and go-to-market strategies. So Nate's a published author. He's phenomenal. He's featured in a ton of Techstars organizations. and comes with us with great demand as well. So we'll send out that sign up within the summary of this email as well. So we look forward to having you join us for that conversation as well. And at the end, we were really excited that you joined us, and feel free to reach out with any questions, and have a great rest of the day. Take care.
Thanks for your time. Take care.